If your tax bill surprised you this year, here is why. That's the topic that we're gonna talk today, right, Carla? Very exciting. This is April. We are in the middle of tax season, so we are gonna talk about this very important subject. A lot of you are filing your taxes right now, and you are wondering, why do I owe so much in taxes? And the answer is almost never what you think. We are a CPA firm that focuses on proactive tax advisory. And what we see every year is almost the same situation. Right, Carla?
That's right. So this is definitely something, it's a question that we get every single day. And most of the time, the issue is not really the actual tax return. It's just that by this time, we're being reactive to the tax return. There was no planning ahead of time. So we have to focus on the information that has already been provided to us, and we need to prepare the return. But if planning was done, then we will be working proactively and not reactive.
That's right. So if you are seeing your tax preparer or your CPA right now for the first time, it's probably already too late.
Too late.
Right? Your outcome has already been decided. You're just really just going out there and filing forms, right? So this is where the advisory part comes in, right? That's the difference between just showing up, here's all my stuff, versus just kind of taking care of things prior, so you don't come to the surprise that we see so much in April. People with disappointment, with shock, in the outcome that they didn't expect, right? And it's because they didn't plan. So we want to break down into like a few points into kind of what really drives this situation, right? And by the time April comes, income has already been earned. Right. Right.
At this time of the year, of course, we're speaking about tax returns for prior year, but we should also be talking about Q1. It's the end of Q1 for 2026. The tax planning has already started for this year, and it can be done at the same time as we are speaking about 2025 still.
That's right. Yeah, it's an issue if you're just playing catch up, right?
Right.
Because that's the problem. So right now, instead of focusing on 2026 and start planning, you're really just kind of still
thinking about 2025.
Yeah. So yeah, it's a problem, And so that's the income, and then the expenses, right? That's another issue, right? So prior year, you had your expenses. You incur your expenses, and then comes April. Right now you're doing your 2025 when you should be planning 2026, right? What expenses are we going to incur? What can we deduct? How are our books looking? Just kind of do that proactive approach to the tax planning, right?
And something else that we look at as part of this process is the structure of your company.
Right.
Do you have the correct structure? Is it time to maybe change it? So that's something else that is part of this process as well. So make sure that you're having those conversations with your tax professional.
That's right, because those are deadlines, right?
Right.
And if you don't do it during the specific time, then you're required to file additional forms, ask for penalty forgiveness, abatements, that kind of stuff, and it's just kind of just create more work, more issues, right? So yeah, and then lastly, no planning. Right? It's just, I always like to kind of always reference to, if you like to run, for example, if you're going to run a marathon, do you just go and run, or do you prepare for a marathon, right? What happens if I just, without preparing, you just go to a marathon the next day, right?
You're not going to be able to walk.
Yeah, exactly, at best, right? Hopefully you can finish, and then if you finish, there's going to be more pain that comes in the other end, right? So, in April is when people usually realize the result. It's not when they create it, right? When do you create it? You create it during that planning phase, right? So now that we got that kind of that set up already, so let's focus into what comes next, right? Which is, what is the reactive versus proactive that you and I talked so much about. It's part of the education that we want to talk to our clients through. No, it's more for us. It's obviously, we want to help our clients, and we clearly see the difference between these two approaches and how one just has immediate effects. It has good outcomes versus just proactive that is, or the reactive that is usually just headaches, exhaustion, disappointment, paying too much, and then doing all that cramped into a short period of time. It's like the perfect storm, right?
And we do see it every day clearly with our clients. We do see the ones that did work with us throughout the year and the outcome when it comes time to prepare the returns versus the ones that barely, that maybe we didn't have as much as communication with them. And then also we see it on clients giving us information the last minute. Right before the deadline or right before, as we are in the middle of the tax season, which is when we get, our workload actually increases. So by that time, we're definitely acting reactively.
Right. And there's nothing harder for us than to say, okay, you should have done that. You could have done that. This is what we would have done had we done this proactive, right? So let's separate these two into camps, right? Let's say who are they reactive, right? So do you talk to their CPA just once a year when you show up in March and April? You're reactive, right? You drop off your documents around March or April, you're reactive.
Right? Do you prepare your financial statements or your bookkeeper or whoever does your financial statements? Are they being done in February because you have to give the information to your accountant, or are they being done throughout the year?
Right. And then our favorite one, right? How much do I owe? Or how much do you think I will owe, right? If you have no idea coming into it during this time, unfortunately, you're going to be on the reactive camp, right? And then, lastly is, can we just scramble fix this, right? What can we do? Do you have a magic, magic bullet, right? And usually the answer is no, right? I mean, what can we do? One thing that we can advise or that we usually talk through is just kind of work through that profit and loss. If they had a business and they're kind of doing their own expenses through the bookkeeping, and we just maybe do some analysis there to see maybe they missed some expenses that were not included in their bank account, stuff that they can actually prove that they have all the support and everything that may be included. Those are maybe the type of things we can do, but generally. Like I said, it's all being done, right?
Right, and there might be some items that maybe we can still do, like a traditional IRA, right? Depending on it depends on the person's case specifically. But there might be still a few things that we can help you with. But like I said, by this time and rushing it, because it's late.
Yeah.
It's very late.
It's late. That's right. So now let's talk about the good guys, the proactive guys, right?
Yes.
So are you planning Q1 right now? If you are my friend in the proactive side, right? Are you planning on making adjustments mid-year? That's the perfect situation, right? That's when you kind of have that midterm right there that you can just kind of go back this year what you've done and just kind of start planning for the year, right? So it's so funny, right? Because it's just something so simple can just save so many headaches, right?
Yes, definitely.
If you can develop that relationship with your CPA, usually during the mid-year, usually we're not that busy, right? I mean, obviously we got work that we have to do, but we have time to spend. We're happy to take our clients through this stuff so that when it comes March and April, we're not going through this whole headache, right? So the next one is model tax scenarios, right? Are you kind of just going through, what if I do this? What if I do that? I'm talking to one client right now. They're considering purchasing a a real estate property
Okay.
for rental,
investment property?
right? Investment property,
Oh, okay.
right? So it's these type of things, you know. It's, do I get the benefit? Can I use the short-term rental loophole? If we, you know, that's a really good benefit. If we have a video just speaking about that one loophole, right? How that can benefit, especially in his case, where he's a high W-2 earner.
Okay.
So you're able to, you know, take some of that active income. You can make some deductions there. So those are the type of things, those scenarios that you want to walk through, right?
Right, and talking about that, we can also go back, and this is something that we have talked about in other videos, but cash flow.
Yeah.
Are you looking at your cash flow? Do you understand how much cash you have and if it can be used for these strategies? Because you have to plan for the entire year, right?
Absolutely.
So if there's some investments or some other things that you want to make now in order to be able to help you for 2026, do you have enough cash flow in order to be able to make those decisions?
Absolutely, and that's a really good point, right? And we said it, cash is not necessarily
Right.
income, right? We
Correct.
talked about this one client that we had that example in which their accountant mentioned that their income went up
Right.
just based on whatever cash was different from prior year.
And somebody actually asked me this week, I have this much income, how come I don't see it reflected in my cash account? There's no cash flow analysis being done there.
Yes. So unfortunately, we'll have to put that person on the reactive side, right? And then making decisions before year end, right? And this is where everything ties together, right? And this is why the planning goes during the year, because then we know that till December 31st is when most of the options are available. We still have some, as you mentioned, there's some retirement stuff that can be done, some other things, but the majority are just done throughout the year, right? So the goal is not to react to taxes. The goal is to control them. It's control your situation, right? And we see that, right, with our clients that are proactive, that are thinking about this stuff during the year.
Right.
We see the difference
Definitely.
when it comes with a fighting time, right? While some of the others are just scrambling around and trying to figure out and all these chaos. You know, usually the ones that plan are just, you know, you can see the difference, right? So let's talk. That kind of brings us into our real examples, right? We already provided some, but when it comes to reactive versus proactive, one specific industry that you and I, Carla, have quite the experience.
Right. We live in Florida.
Yes, and is with our friends, the realtors.
The realtors,
right?
Yep.
And then what happens with the realtors is that, not to pick on realtors, but just to give an example, you know, there is a good example when it comes to planning, right? And we know that, for example, like someone that is a realtor is not steady income, right? It can fluctuate depending on, you know, some of them have good months, some of them don't have some, you know, good months where maybe they're not selling as many houses or if any at all. And they're worried that, like, let's say, for example, putting themselves through payroll.
Right, and one of the things that we see a lot, especially with realtors, obviously, is that they don't see themselves as a business.
That's right.
And they certainly are a business.
That's right.
And that's how they need to look at themselves in order to be able to plan throughout the year for their taxes.
Absolutely. And then the key with that is, if you don't see yourself as a business, if you don't act like a business, the IRS is not going to take you as a business. So you can't do one thing and expect the other, right? You can't just be acting as, you know, as an individual, just not organized, like as we're saying as a business, and then expect the IRS to
Right.
give you the business treatment, right?
Exactly.
And why does it even matter? And it's because, like, as business owners, we get certain, you get deductions, you get
Right.
credits, you get, you
Benefits.
get benefits that if you work them, if you act correctly and you make the right selections, if you make the right moves, if you make the right associations between your personal and the business, pass-throughs, whatever the case may be, because everyone's different, but if you make those right choices, usually those are presented to you as a business, right?
Right.
But that's the key. You have to
Right.
act as a business, see yourself as a business, and then just make the right decisions, right?
Right, and we also see in our practice people that start the process but never actually finish it.
That's
So,
right.
and an example would be a realtor that becomes an S corp, but then they don't pay themselves via payroll, which is
Absolutely.
a must in a
That's right.
in an S corporation.
Yeah.
So don't stop halfway. If you're already making the path to becoming an S corp in order to be able to take advantage of all of those benefits, then finish it. Start payroll. Speak to your financial advisor about a retirement plan. There's a lot that needs to be done, but you need to speak to a professional in order to be able to know, right, everything that is out there that will help you. So again, if you are already an S corp, make sure that you're taking advantage of everything that can be taken advantage of as an S corporation.
Absolutely. And also on the flip side is, don't just turn into an S corp because you listen to someone on TikTok.
No.
Right. Not everyone should be an S corp.
Correct. There's analysis behind
Yeah,
it before you make that
exactly,
decision.
Exactly. Yeah. And then our example number 2 is our investors, right? And these are, we already kind of provided a few examples, but a good one is, when you're purchasing real estate, that is
Right.
usually one of those options that you have. If you're a high income earner, you have some money you can put aside, for even after you put maybe some money into a 401k after some retirement, you still have some money left over. Typically, investing in real estate is a good, obviously under the right conditions, right?
Right.
Because not every real estate deal is good, but under the right circumstances or under the right opportunities, it could be a good deal, right? Whether it's a long-term rental or a short-term rental through Airbnb, any of those are usually can be a good example, a good opportunity for some of those, right? And as part of that, it's because we can separate those into two things, right? One is the business opportunity, right?
Right.
Like you do your research and the property provides good cash flow. It's in a good area where you can easily replace rentals,
Right.
or it's very touristy, so you have a lot of activity. So if you want to go into a short-term route, then there's a lot of some turnover there that can help
Right.
you. So that's that good side of the financially, right? And then there's the other side, which is the tax, right? Is it what can I get out of it tax-wise? And that's where we put in, depreciation, right? Are you depreciating it correctly? Did you take advantage of cost segregation? Now the thing about cost segregation, for example, is usually that's a long-term strategy.
Right.
If you're thinking about flipping the house a few years shortly after, cost segregation may not be a good idea because you may have to pay whatever benefit you get, you may have to pay it back, right?
Right. So definitely, if this is something that you are considering, you need to speak to a professional before you make the decision.
Absolutely.
To make sure that you understand everything that is out there that will be able to help you, but also know the consequences of making some of the decisions.
Absolutely, yeah, and especially true if you're like, let's say, deciding between different properties, stuff
Right.
like that. You can maybe what can kind of move the needle is which one do I get the best tax advantage. So yeah, and then our next example is the higher earners, right? The higher earners.
Right.
those are like our our W-2 earners, and usually W-2 it's the type of income that it's kind of ironclad in that those are kind of put you in a
box.
In a box, that's right. In a bracket, in a box within a bracket that it's usually pretty kind of staying still, if we can call it that, in terms of what some of the things that you can do strategy-wise. There's definitely some things you can do, but there's specifically those to them, right? Versus, for example, a business owner that maybe has some more flexibility. With W-2 earners, it's kind of its own. It's kind of on its own, right?
And we see a lot of doctors, we see attorneys, we see company CEOs, CFOs, or executives, let's call them executives. So we do have a lot of clients that are high earners that are our W-2.
Absolutely.
Don't necessarily own a business.
Absolutely, yeah. And we have those strategy kind of already set up for them. Usually we'll set up like 5 to 10 strategies, just because there may be some that are like that they may like. There are some others that may not be that interested in, because certain steps that maybe they don't want to take, or maybe some make more sense than others. But we have strategies specifically for our high earners that they're usually happy with. But usually kind of what some of the things that they may need to look out for is kind of what we see them more struggle is like on tax payments, estimated payments, right? And usually not following the safe harbor rule, right? Those are usually the two that can cause some pain to our high earners, and why doing the strategy during the year, it's key. Yep. So, so what is the difference here? The difference is not income, right? It's the planning. That's the difference, right? So, just because you're a high earner, just because you're a realtor, whatever your situation is, if you plan, you can just jump over any hurdle that may be put before you. Right.
And there will be no surprises.
Yeah,
because
exactly.
most of the time, there will be no surprises, because it has been planned throughout the year with projections, and the numbers are in there. They're projected numbers, but they are being included in a formula. So by the time that we file your tax returns, it shouldn't be a surprise.
Right. And usually that's the biggest thing. It's just a surprise, right? Because once you kind of if you get through that shock, the initial shock, you kind of just and then it comes then the questioning, right? Why didn't I do this? Why didn't my accountant talk to me? Why didn't they offer me this option? But then it comes, then the question is, when did you meet with them, right? How often did you guys discuss these things?
And that is actually something that we saw this week, again, because it's tax season, but it was the reverse. It was actually that they were paying too much in estimated taxes.
That's right.
When their income was not compared to, it was not at the same level that it was the year before.
Absolutely.
So they were practically giving money to the IRS to hold as a savings, and now they're getting a lot of it back because they paid too much in estimated payments.
Right. That's right. Yeah, and that's when, when getting a refund might sound like, oh, it's so nice, I'm getting a refund. You're really just kind of getting back what you overpaid, right?
Exactly.
So, in some instances, a small amount or a reasonable amount of refund, it's okay, right? But there could be an amount that you just basically loaning interest-free to the government, money that you shouldn't, you could have used for some other, to actually generate income. Right?
Exactly. You could have been using that money to generate income, like you said, in a savings account, earning interest, or whatever the case may be.
Right.
But instead, it was just not in your bank account.
Sitting somewhere.
Somewhere.
That's right. Yeah. So having said all of this, right? So why does this keep happening, right? Why does this happen every year? It's a key, right? Something that we here up from CPA kind of work through, right? Just kind of work with our clients to just kind of get them from the one side to the other, right? Where we can clearly see the benefits, right? And number one is is basically the kind of the main one, right? Is that people think that taxes is just an annual thing,
Right.
right?
Yeah, because they see it as my annual tax return.
That's
But
right.
that doesn't mean that you just look at it, that you only look at it or think about it once a year. That's
right.
completely incorrect.
That's right. Yeah, it's kind of a misconception that it just kind of it gets lost in, oh, it's April 15th, it's when taxes are due, it's when everyone's talking about it, it's when all the the so-called experts are on TikTok giving advice. It's when like you're kind of used to that's when taxes are done. But it's April 15th is when the filing is due.
Right.
When taxes for the prior year, when you can make that final payment, right?
Right.
But it's
For the personal returns.
that's right. But that's when that takes place. But that doesn't mean that that's how it should be done.
Right.
Especially, the key here is, that's when that key event happens. You actually want to just go through it during the year to avoid, exactly what we're talking about today,
Right.
which is why do I owe so much?
Right, exactly. So, which means that you need to be talking to your tax professional, to your CPA, to your tax advisor throughout the year. Before December, you need to be talking to them. At least we recommend that quarterly, at least 2 or 3 times a year.
That's right. Yeah. So that's what proactive looks like, right?
Correct.
And it's not hard. It's not difficult, right?
Correct.
As we mentioned before. So that kind of brings us from there into the next, which is lack of communication with your CPA, right? We here at Upfront CPA, we're very transparent. We're open to communication with our clients. If you kind of go through our reviews, you'll see that a lot of people, one topic that we see a lot that we see quite often is the open communication that our clients share with us, right? I think one advice or recommendation that I like to offer personally to either prospective client, a friend, family is if you don't have that relationship with your CPA where if you make an attempt to meet with them and for some reason you get some kind of pushback or not interest in kind of just start setting up a meeting with them,
Right.
or that's a sort of a red flag,
Right.
because like a good CPA has even if they're not just kind of doing this advisory
Right.
sort of service, they should know the benefit of just meeting with you, just kind of just going through your books, see where you stand. If you're not able to have that relationship, I won't say fire your CPA, but maybe have a discussion first. And if you can work something out, good. If not, then unfortunately, it may be a case that you may need to change it.
Right, because you need to be somebody that is playing as part of your team.
Exactly.
Right. This is definitely teamwork. It takes a lot of. It takes a village for this, and the CPA should be able to sit with you throughout the year and plan with you. If they are only talking to you during tax season, they are being reactive, which is
right.
exactly what we're telling you not to be.
Exactly, and that moves us into the next one, which is setting up a system for the planning, right?
Correct.
Because that's when once you start meeting with them regularly, then you kind of start setting up that system, right?
Correct.
That kind of that habit of taking advantage of those credit deductions, things that are provided to you, right? That you can get ahead and do it while you're able to. But during that use it during that time, right? And then lastly is focus on compliance instead of strategy, right?
Right.
So strategy is where you want to be. Strategy is what's going to get you from saying, why do I owe so much, to, well, I'm paying less than I thought, best case, right? Or I feel so much better now. Like what's the word we hear a lot? It's peace of mind, right? I feel so much better, like a ton was lifted off my shoulders.
I can sleep better.
I can sleep better. That's right. I mean, it's serious, right? We see that quite often, and in our profession, we're in this situation where we can help our clients, kind of direct them in the right way.
Right, and we do see it in some of our clients that just get absolutely super nervous during this time of the year. But you shouldn't feel like that. I understand why they do, but if you have already planned and you already know the information throughout the year, by the time the tax season comes, you shouldn't be nervous because you already know what to expect.
That's right. So if you're nervous, you unfortunately probably on the reactive side. But we'll get you to the proactive side.
Right.
We'll get you there. So lastly, we want to talk about, what you want to do moving forward, right? So that was kind of like the bad news type of thing. Now let's get into, okay, Julian, fine. I'm on the reactive side. I want to join the good team, the winning team.
I want to make a change.
Exactly.
Change is good.
Exactly. So right now, step number 1 is pick up that phone and call your CPA. Right? Right now it's April. Right now it's everyone's doing with taxes, so it may not be the best time. But after April 15th, after all the madness and craziness, call them and say, okay, 2025 is done. I want to start planning 2026.
I'm ready.
Number 1, right? Number 2 is after you talk about, it's shortly after tax season. We're talking about sometime after April. Talk about doing a mid-year review. Right? So you're just kind of setting up the groundwork for, hey, I'm not just calling just to drop in, just for the sake of calling. I want to set up a system.
Exactly. Make sure your accounting is up to date, that your bank accounts are reconciled, that you are looking at projections through the end of the year, comparing year to year as well, because obviously that's going to make a difference, right? When tax season comes as well, the variance between one year and the other. So make sure your accounting is always up to date.
Absolutely.
Never leave that behind.
Absolutely. Yeah, and as part of that planning, you're going to track your income, right?
Right.
Make sure you're tracking your income properly. Make sure you're also tracking your expenses and your cash flow. Right?
Correct.
Those are going to be kind of your 3 directives there during your Q1 and your mid-year review, right? And then, lastly is, before year end, right? Just kind of, you had those 2. Now it's going to say, now, I want you to put on your calendar for me to meet with me somewhere between November and December, right? Before I go on vacation. I kind of want to see what last minute thing or, prior to year end things I can do, right?
What the big picture looks like.
Exactly. Before year end, what's kind of like what pencils down, now's the time, right? So I think kind of like the summary here is April is not the time to fix things. April is when you say, how much do I owe taxes, and you're sweating. And the time is, so you want to do this during the year, and all of these issues will go away.
Exactly. So the time is right now. Right now for the new year, it's time to change if you haven't been doing this in the past, and believe us, it's going to make a big difference.
Exactly. And I will say that if after hearing us, you feel frustrated, you feel that you're like you're on the edge, that may actually be a good thing. Because it means that I think you're ready to make a change, and we trust that you will.
Right. And always make sure, again, that you have good communication. If you call somebody's office and they don't have availability to speak to you or to actually sit down and meet with you, then that's already a sign that maybe you need to keep exploring. Make sure you choose the correct person for you and your business.
That's right.
The correct team.
That's right. So I think that about wraps it up. I want to thank my special partner Carla for joining me today. We don't always do the videos together, but I always enjoy when we do them together. If you like this content, please hit that like button and follow us for more content like this.
Until next time.